Are you buying a home right now? Are home interest rates coming down? Are you looking into refinancing your home and waiting for a better interest rate? In this video, I'm going to share information with you right here, right now. Where are the mortgage rates headed? Are they going up? Are they coming down? Are they staying stuck? Right? We're going to go ahead and walk through three of the most likely scenarios and talk about why the Federal Reserve is in the situation that they are in right now. What might they do? And then also cover the wild card that could change everything as well. Then we'll go ahead and get practical, right? Should you refinance? The big question also is, should I buy a home right now? Right? By the end of this video, I hope that you'll have a clear picture on the outlook of all this and know exactly what moves you should consider based on your situation and what's best for your own financial well-being. I'm going to be straight with you. All this stuff right here is real data, okay? No guessing, just facts, not just all my opinion, and I'm going to share it as simple as possible for your understanding, okay? That's just my style. So please right now, right click on that thumbs up, that like button. Please give me a subscribe. Click on that subscribe button. And don't forget, if you've got any questions, okay, any thoughts on the housing market, drop it into the comments and I will try my absolute best to respond back to you as well. Okay, let's go ahead and dive into it. All right, so are mortgage rates going up? Are they going to come down or are they just going to stay where they are? This answers the question everyone is asking. There are basically three ways that this could play out, okay? If you take a look at the first card on the left, rates go higher. This would happen if the conflict in the Middle East keeps disrupting the supply of oil and gas, okay? Of course, when energy gets more expensive, okay, the price of basically everything goes up. So what I'm trying to say is that, okay, if oil is going to continue to stay expensive, gas is going to continue to rise and be even more expensive. And what that means is that all the trucks on the road that transport our goods to the stores that we buy them at, okay, the fuel it takes to transport all our goods is going to cost more to actually ship these items. Okay, once they get to the store and before, I mean, when we buy them, the prices are already set up for us to, you know, uh, consume and absorb. That's what ends up happening. So basically, when the price goes up, everything goes up as well. Okay, that means that if inflation stays hot, okay, and when inflation stays hot, the 10-year treasury yield goes up. Okay, the mortgage rates are also going to follow the 10-year treasury yield. All right. Now, for those of you who didn't watch my other video on uh, purchasing a home and home interest rates and stuff like that, okay, a treasury yield is essentially the interest rate that you make back from loaning the government money, okay? So essentially what happens is you get what they call a 10-year treasury bond, right? And then there's a yield interest rate on that, which is going to be 4 to 5%, whatever it might be. If you give them $10,000, you're going to get back the 4 to 5% on that $10,000. That's essentially what it is. And so, again, going back when inflation is hot, the 10-year treasury yield is going to be up there. It's going to continue climbing up, which like right now it's doing that right now today, okay? The mortgage rates are going to follow that as well. So, in this scenario, rates could push towards 7 to 8% from the 6.6 that it's at right now, okay? Now, let's take a look at the middle, okay, where it says rates come down. This could happen if the war de-escalates and energy prices drop back down. Okay, lower energy means that inflation is going to be less. Okay, and less inflation means that, remember, the 10-year treasury yield, that interest rate is going to come down, and then the mortgage rates are going to follow that 10-year treasury yield rate. Okay, also, the Federal Reserve, right? They could step in and directly buy government bonds. That's called quantitative easing. But all it really means is the Fed creates money and then uses it to buy bonds, which of course pushes the interest rates down. Okay. In this scenario, the rates could drop back towards 5.5%, 6% maybe. Okay, lower than where it's at right now. Then if you take a look at the last one on the bottom, okay, where it says rates stay stuck in the blue. This is what happens when you have forces pushing in both directions at the same time, okay? Inflation is pushing rates up, but the Fed is trying to push them down. They cancel each other out, and then nothing really changes, okay? Rates practically just bounce around in that 6 to 7% range. So those are our possible paths right now. All right, so your question probably is what's the most likely outcome of all three, right? Of all three possibilities, what's the most likely outcome? Basically, I mean, they're going to keep bouncing around 6 to 7%. That's my opinion, okay? They're going to keep bouncing between 6 to 7% in that zone for the rest of 2026. And here's why. So regardless of the conflict out there in Iran, right, the inflation is probably going to stay higher than normal for the rest of the year. Energy prices aren't just going to snap back overnight, too. I mean, that's one thing that I'm keeping my eye out on is the aftershock. Even if, let's say, for example, the negotiations go perfect this week, we get, everything signed and everybody agrees to allow all the ships to flow back through the strait, right? Everything's great. Energy is just not going to snap back into place. I wonder how the aftershocks on that's going to be. I'm going to keep my eye out on that. So, anyways, when inflation stays elevated, okay, the treasury yields are going to stay elevated. And guess what that means for the mortgage rates? Yes, they're going to stay elevated too because they follow that, right? Now, rates could dip back down below 6% or maybe even get to about maybe 5.5% for a little while. Sure, that's possible, but they're not going anywhere close to 3%. That's my opinion. Okay, the whole pre-pandemic era of rates, that once in a lifetime generation of rates, in my opinion, that's gone, at least for now. Something major is going to have to change in order for us to get back to that point, and it's, in my opinion, is not going to happen anytime soon. The Feds printed trillions of dollars. You know, they can push the rates back down uh, again, but that's not going to happen anytime soon. So again, even more reason to watch what's going on with the Federal Reserve and what their decisions are going to be. So the realistic expectation for me is that rates are going to stay in between that 6 to 7% range. They could likely go higher to 8% as well as if inflation really takes off. Okay, but right now, again, the 6 to 7% is the path that I think that's like the hallway for us all. Rates are walking back and forth between that and they might touch one wall or the other, but they're not going to be breaking through. That's the bottom line. Here's what the Federal Reserve might do and how it could change things, okay? So here's what the market is currently expecting. If you look at the left side of the screen under market expectations, you can see the three scenarios, okay? At the bottom, there's a 0% chance that the Fed cuts rates this year. Above that, there's a 56.4% chance that they hold steady. And then at the top, there's actually a 43.6% chance that they raise rates. So the market is basically saying do not expect any help from the Federal Reserve on rate cuts. Now, if you take a look at the box on the right labeled the wild card, here's the big unknown. There's a new person that's running the Federal Reserve, Kevin Warsh, right? He was appointed by President Trump, and we don't really know what he wants to do yet. I mean, he's initially, prior to him coming on board, right? I mean, they thought that he wanted to cut rates, but he's in such a difficult situation right now with rates and inflation. But him being on board, here's why that matters, okay? The Fed has two main tools. The first one is cutting or raising interest rates. And that's what everybody talks about. And then the second tool is buying and selling bonds. When the Fed buys government bonds, it pushes yields down, okay? And that directly brings the mortgage rates down as well. That's what they did back in 2020 during the pandemic. It's why rates dropped to 3%, okay? So even if they don't cut rates, they could still bring mortgage rates down by buying bonds. But, the main thing is we're not going to know more about what Kevin Warsh's plans are until the next meeting, and that's going to be on June 17th. Okay. Now, that's a date for you to keep an eye on. If you're interested in buying a home, you want to know what Kevin Warsh has planned for us. So keep an eye out on that. Research on the news, watch the news on TV, on YouTube. Okay. Keep up with that. Now, did you want to know whether or not you should refinance your mortgage right now? Let me tell you first, right? Refinancing. What is it? It's practically refinancing is when you replace your current mortgage with a new one, usually to get a better interest rate and usually to get a better, lower monthly down payment. I mean, there could be other factors too, but that's the main thing. If you locked in at 7% and rates dropped to 5.5%, you could refinance and your monthly payment will go down, right? So, the question is, should you do that right now? In my opinion, short answer is no. Okay. Not right now. And here's why. The rates are at 6.6% and they are expected to stay in this range. And there's no sign of a big drop coming down anytime soon. Okay. So if you refinance today, you're locking in at a rate that might not be better than what you already have. What does that mean? You're going to be technically paying more than what you're paying now. Okay. But here's the thing to watch out for. Sometimes the Fed takes emergency action. Maybe if there's a financial crisis, maybe the economy suddenly tanks, right? You don't know, especially the way that the AI equities are blowing up right now and going parabolic and everything. The investors, all the institutional investors, everybody's bullish and throwing money in their um, fears of a bubble. If all this stuff creates some sort of crisis, right, and the Fed steps in to slash rates, cut rates down, and they do that by buying bonds aggressively. When that happens, mortgage rates can temporarily drop really fast. And that, my friend, that would be your window to get in on that refinance. Okay. Those dips don't usually last very long, too. So that's why I mentioned, okay, keep an eye out on the information coming from the Federal Reserve. Keep an eye out on what Kevin Warsh tells us that he's going to do. So you need to be ready. So have your paperwork in order, right? Be prepared. Know what rate would make things worth it for you to pursue this. And then when that dip comes in, right, you got to move quickly on it. Don't wait around hoping that it gets even lower, right? Lock it in while you can. That's my opinion. How about the question of, should I buy a home, right? That's something everybody's always asking, right? Everyone's always asking, is right now the right time to buy? And let me give you the answer to that, okay? The answer depends on what you're trying to do, right? At the end of the day, it's always your goal. You can see on the slide, okay, I've got a left column, a right column, okay? On the left column, it says if you're going to buy to live in and you plan to stay there for at least 5 years, then yes, I mean, that would be plausible, right? It'd be reasonable for you to actually make a home purchase for a home that you actually want to live in, want to stay in, right? It's still a good time to be shopping for that. And here's why. The best time to buy a home has always been in the past, okay? That was your younger days. Yesterday was better than today. Last year was better than this year, right? Pre-COVID was better than today. 10 years ago was better, okay? Home prices have gone up every decade for as long as anyone can remember here in America. So, what does waiting mean? Okay, so usually what that equates to is waiting usually means that you're going to be paying more, right? Plus, inflation actually helps you when you own a home, okay? As prices go up, the value of your home is going to go up. That's what a lot of people look forward to, right? You gain equity in your home, but your mortgage payment stays the same if you have a fixed rate. And that's the nice thing of it. So over time, your home becomes worth more while your payment stays locked in, and that's how you can build wealth through owning a home. Now, that doesn't mean go out and panic buy the first thing that you see, right? That's not my advice again. And my opinion is that, I mean, you should be mindful about these big decisions that you make, and you should be patient and be sound while you're shopping. Look for a good deal, right? It took 11 months to find a first home for me, and that's just totally fine. Okay? Good deals are out there, but they take time to find. Now, if you take a look at the right column, okay, if you are investing or you're trying to flip a home, right? This is something completely different, okay? A whole different conversation. You're not trying to live in that place. You're just trying to make some sort of hope that you make money out of it. That strategy is going to be about timing and about margins, right? How much you're going to actually profit. And right now, with high rates and high prices, the margins are super thin. And if you take a look at the bottom of the slide, right, you'll see something that's highlighted down there, the catch 22. Okay. People keep saying, I will wait for rates to drop, but here's the thing. If rates drop significantly, home prices will go up because more buyers are obviously going to jump into the market. So you might get a lower rate, but what happens, right? You're going to be paying more for the house. The total cost might end up being about the same. Affordability is not, going to get a lot better either way. So I'd like to wrap this up by saying that, the last or the most likely outcome for mortgage rates is that they stay in the 6 to 7% range for the rest of 2026. They might dip briefly, right? They might bump up, but they're not going to go back to that 3% range that a lot of people are hoping to see. Okay. That's just keeping it real. The new Fed chair, Kevin Warsh, right? He's the biggest unknown factor right now as well. His first meeting will be June 17th, right? Keep an eye out on that. Listen to what he's got to say. I'll make an update video on what he announces as well. That way you all know. So remember, right? Click that notification button. That way once I pop out new videos, you'll see it. I think that Kevin Warsh could surprise everybody by buying bonds aggressively, right? Which what's that mean for you? It's going to push rates down fast. Or, I mean, who knows? He could hold steady, let things play out, and see what kind of decision he wants to make in the uh, foreseeable future. If you're thinking about refinancing, my opinion is hold off for now, right? Rates are obviously too high. You're probably locked, especially if you're locked in a really good rate. And then, wait for one of those emergency Fed moves where rates temporarily drop. When that window opens, you got to take advantage of it, move fast, right? Because like I mentioned before, it's not going to stay open for a long time. So have things lined up, have your paperwork ready, have your loan officer you're working with ready, right? Position yourself for that. If you're thinking about buying a home to live in, somewhere where, like mentioned before in the last slide, at least 5 years or more, then of course, yeah, if you start shopping, that'd be fine, right? Just don't panic buy. But at the same time, don't wait around for the perfect condition either. Because here's the reality. If rates drop, home prices go up because more buyers are going to flood the market. Okay. Remember my story? I mentioned the you're all of a sudden you find yourself competing and bidding against people who's got more money than you, cash buyers, etc. And it just makes things a whole lot more challenging to get your so-called dream home, the home that you actually prefer to be in. Now, if rates stay high, monthly payments stay high too. There's no magic moment where everything's going to become affordable. Okay, so best move is be smart, be patient, be ready to act when the time is right, when the deals show up, when the interest rate is good, and the right deal for you, right, is going to be based off of your situation. What's good for your financial well-being? What's your goals, right? Have those things in mind, have those things in line, make the right decisions based off of that. Now, uh, that's it. Thank you so much for watching. I'd appreciate it if you gave me a thumbs up, click on that like button, press that subscribe button for me If you've got any questions, any comments, anything that concerns you about the housing market, drop it into the comment. I'll respond. All right. Thank you for watching. Again, it's Curtis. Make it a great day.